This is Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 4 videos on trading in tight bear channels. I keep coming back to the same point. When a channel is very tight, a bear channel is very tight, you should only be looking to sell. If you see that it's really difficult for bulls to make money, that tells you that the bears are strong and you should only sell. This is a bear trend in the euro versus the dollar 5-minute chart, and the channel is tight. The pullbacks are small and brief, but they're frequent. The market's repeatedly trying to reverse. However, each pullback attempt results in a bear flag and resumption of the bear trend, or in a trading range. In either case, it's difficult for the bulls to make money. And it's easy for the bears either to make money or avoid a loss. If a bear is short, his stop is getting far away, the trend itself is not particularly strong, a lot of bears will start to take partial profits at new lows, and the result is you keep getting pullbacks. A lot of times, initially, bulls will be buying at new lows for scalps. However, they're unable to make money. The pullbacks barely go above breakout points. The pullbacks do not go up very far. Very difficult for the bulls to make money. At some point, they give up, and then they stop buying for a while. Most bulls are not going to be taking these buys. This bar went above that bar. It's a reversal attempt. Most bulls are not going to take it. The pullbacks are brief, small, not big enough for a profit. Sometimes they're a little bit bigger, but they're still minor. Only 4 or 5 bars up, 4 or 5 bars up. Still more likely either a bear flag or a bull leg in what will become a trading range. The bulls are not holding on to their trades. They're not holding for swings, and therefore they're not terribly confident that the market's going to go very far. And the bears are eager to sell. Anytime the market gets up to the midpoint of the last bear leg, they sell. Anytime it gets up to a prior high, they sell, a double top bear flag. Even if you sell at the worst price, the risk of losing money is small, especially if you can scale in higher. And if you do lose, you're probably not going to lose much. Whereas the bulls are losing all the way down, and therefore traders should only be selling. The bears are very eager to sell all of these reversals. Even when they're strong, the bears are selling. And you can see we get a reversal and another leg down. Every trend is constantly forming a wedge reversal. Bear trends are always forming wedge bottoms. And when you get a reversal up from a wedge bottom, the target is the bull trend line. Yet the bull trend line is so close that it's impossible to make money. For example, if you look at this and call it a wedge or a nested wedge, a small wedge inside of a bigger wedge, and you decide to buy here, your target is the top of the wedge channel, the bear trend line, and you're buying exactly where you should be taking profits. So you cannot make profit doing that. And here, same thing. If you're in a tight channel, a bear channel, and you're buying a reversal up, your target is the top of the channel. And if your buy entry price is already at the target, it's impossible to make money. There's no room for profit. Whenever the market is in a fairly tight bear channel, never enter with a stop because the pullback is going to be small and you're already buying too high up. If you're buying with a stop, it's probably not going much higher and therefore there's no room for a profit. So you should absolutely never enter with a stop entry because when you're entering with a stop entry, you're buying above the high of bars and the reversal is probably not going to go high enough up for you to make a profit. Wedge reversals are great if the legs within the wedge are very broad. When the legs are very tiny like this, the wedge reversal is going to be a bear flag and the market's going to continue lower. Again, bear trends are always forming wedge bottoms and the reversal attempts become bear flags, not bull trends. 5-minute chart of the US dollar versus the Canadian dollar. We're in a trading range, slightly lower highs, maybe a channel, and then clearly a channel at this point. I always pay attention to whether or not after the market breaks below a prior low, when it pulls back, does the pullback go above the prior low? And if bulls see that, they think they can make profits, and usually they can. So they either buy at that low and add on the size of a scalp lower, for example, 10 pips in the Forex markets, and then get out break even on their first entry, or they do not take the first buy, they simply buy 10 pips lower, expecting the pullback to go back above the breakout point. For example, this pullback went above that breakout point. This low immediately reversed above the breakout point. This low reversed above the breakout point. The reversals are small, probably too early to be buying at new lows, but some bulls will. They'll either buy as this bar falls below that bar, or as any of these bars fall below the prior bar. For example, they might buy here at that low with a limit order, looking to scale in lower, betting that there'll be a reversal big enough up so that they'll make a profit on their lower entry. They're hoping that the market immediately goes up here and they make a profit on their first entry. They believe that with all the gaps closing, with all the pullbacks going above the breakout points, the market will soon evolve into a trading range, and therefore they are willing to scale in. Most traders should not be doing that. When a trend is very tight, a channel is very tight like this, traders should only sell. When it's very difficult for the bulls to make money, and when they can make very little money, it makes much more sense to only sell. A bull taking a buy like this, looking for a 10 pip scalp, is going to have to risk probably more than what most traders would like to for a reward that size. He probably would have to risk 20, 30, or 40 pips to make 10 pips. And he probably has to scale in 2, 3, 4, sometimes even 5 times using a very wide stop. If a trader is using a very wide stop like this, maybe based upon some kind of a measured move, based upon a prior leg, it's a catastrophic stop. He's never going to let that stop get hit. He's going to get out before the stop is hit. By a catastrophic stop, what I mean is he has that stop there in case something terrible happens, surprisingly. For example, a huge collapse on some news event, or if he loses electricity, or if he gets called away for an emergency and he doesn't exit his position. He wants a stop that will protect him from a huge loss. Well, I said when you're buying in a bear trend, a lot of traders buy at the low and scale in lower, like 10 pips lower, 20 pips lower. Each entry you want to be the size of a scalp or bigger. Minimum scalp in the Forex market is 10 pips, and therefore you're going to buy 10 pips and 20 pips below your first entry. If the market goes up immediately from your first entry, you make your 10 pips profit. You're not going to be swing trading because the channel is very tight and the reversal is going to be minor, not a major reversal into a bull trend, and therefore it's unreasonable to be swing trading. These are scalp strategies. The bull taking this scale in trade got out here at his original entry price, break even on his first trade. He made 10 pips profit on his second and 20 pips profit on his third. And therefore he had a total profit of 30 pips. If he bought a fourth time, right here, 10 pips lower, if the market kept going down and then the market reversed up, he would have made 30 pips on that trade. However, on the other hand, if it fell here and fell 10 more pips below that, his stop would have been hit and he would have lost money on all of his entries. He would have lost 40 pips on his first entry. Remember, the stop here is 40 pips below. He would have lost 30 pips on his second, 20 pips on his third, and then 10 pips on his fourth. And if you add up all of those losses, his total loss would have been 100 pips. I want to be very clear about this. Very few traders should do this. Very few traders do this. And it's an absolutely horrible strategy for beginners because beginners only think about risk. And the result is they will not concentrate on proper management. And invariably, they'll be trading a size that is too big. They think that, oh, I'm going to add on 10, 20, 30 pips lower, when in fact, that was never their intention. And their first entry, second entry, third entry are all far too big. And therefore, their risk is far beyond their comfort zone. And they'll end up getting out at the market before their stop is hit and before the reversal takes place. Or if they take their third entry, and as soon as it rallies 10 pips or so to their third entry, they'll get out and take a loss on the first two entries and a 10 pips profit on the second. They will manage the trade badly because all they'll be thinking about is risk, and their risk will be greater than it should be because invariably they'll be trading too large. So beginners should never do anything like this. When I'm trading and the channel is this tight, I'm not buying these lows. I don't start to buy until after I see a pretty good reversal up. When I see this and I see how difficult it is for bulls to make money, I only want to sell. This is a terrible strategy for most traders, and it's an absolutely horrible strategy for beginners. Do not do it. How can it possibly be a good strategy for anybody? Well, a scale-in bull, as I said, if he's willing to buy more a second time, third time, and fourth time, he's exposing himself to a total risk of 100 pips, and he might only make 20, 30, 40 pips, depending on how many times he had to scale in. But his initial risk was 100 pips. How can that possibly result in a positive trader's equation? How can it be a good strategy? Well, whenever you scale in, you're increasing the probability of making money. Scaling in a strategy like this, you need to be right 80% of the time, maybe 90% of the time to make money. You pay for that great probability with bad risk reward. Your reward is very small relative to your risk. Your risk is relatively big. I said that some traders will do this, especially institutional traders or computer algorithms. The reason they'll do it is because the probability is high and the risk is less than 100 pips on most trades. Most trades, you're going to get out before your stop gets hit. You'll decide that the strategy is no longer valid and you'll get out before the stop is hit. Also, most of the winners will be 10 to 20 or 30 pips. This is a good strategy in a broad bear channel. And an expert trader in a broad bear channel can expect to win 90% of the time. And his average win might be 30 pips. If he takes 10 trades and he wins on 9 of the 10 trades, he wins 9 times 30 pips for a total of 270 pips. And he loses once. In other words, one time his stop gets hit and he'll lose his 100 pips one time. And therefore, his total wins add up to 270 pips. His one loss is 90 pips. And he ends up with a 170 pip profit. So in a broad channel, this can be a good strategy for an expert trader. In a tight channel, I think it's a stupid strategy for anybody. But theoretically, traders can make money doing it. For example, if you're buying at this low, you get filled here, it does not go up 10 pips, you do not get a profit. You'll get out on a reversal down. So you might make 2 or 3 pips, you might lose 2 or 3 pips, but it's really difficult to make money. And if you look at that, and it's very difficult for the bulls to make money, that tells you that the market is probably going lower. And even if you're doing the scale in strategy, your average win is probably only 10 or 15 pips. A lot of the traders who take these buys are disappointed by the size of the sell-off, and the traders will try to get out break even on the trade instead of with a profit. So for example, if a trader bought here, he bought more here, and he bought more here, he might be concerned that the market fell for 6 bars, 5 bars, and he might be concerned it may fall for more, and therefore he may not try to get out break even on his first entry. He may try to just avoid a loss, get out at his average entry price, which is right here. He bought here, bought more 10 pips lower, bought more below this. His average price is right here, so he may simply get out here with no profit at all. He's just trying to avoid a loss instead of trying to make a profit. Even if a trader were to win 90% of the time, he barely makes enough money to make it a very good strategy. Most profitable traders would never buy when the market looks like this in a tight channel. This is a big breakout on the next higher time frame, and buying a bear breakout is a terrible strategy. It's a losing strategy. And buying, even with limit orders and scaling in, is a terrible strategy when the channel is tight. When you start to see small bars and you're seeing bear breakouts with no energy, weak breakout bars, small breakout, weak follow through, weak follow through, some traders will consider scaling in, betting that the market will soon evolve into a trading range. The bulls who are taking these buys know the market's always in short. They know that any reversal, even one that lasts 5 or 10 bars, is still going to either be a bear flag leading to lower prices or a bull leg in what will become a trading range. The upside is small. Very small probability of this becoming a major reversal. And that is why if they scale in lower, they're just going to try to get out at their original entry. Remember, if you bought here and bought here, to get out at your original entry, you need a bounce up of 20 pips, which is a lot when you look at how small the reversals have been. When it's difficult for the bulls to make money, that tells you that the bears are much stronger than the bulls, and you should only be looking to sell. On this particular chart, the bars are big. They are about 20 pips tall. This is a 5-minute chart of the dollar versus the Canadian dollar. And a lot of bulls, instead of scaling in 10 pips lower, they'll scale in 20 pips lower. And instead of trying to scalp out for 10 pips, a lot of them will try to scalp out for 20 pips. And if a bull is willing to scale in many times, his risk could be as much as 100 pips. For example, let's say a bull looked at this and saw small bars, maybe a wedge, 1, 2, 3. Remember, bear trends are always forming wedges, but when the wedge channel is tight, it's a terrible strategy because the market is probably going to go lower, a lot lower. All right, well, let's say that a bull bought with a limit order at this low, betting that we'll test this high or that high. And let's say he scales in 20 pips lower, betting that the pullback from this bear breakout will go back above the breakout point, and he can get out break even on his first entry and with 20 pips profit on his second entry. And then he sees this. The market rallies for 4 bars and then has a bear bar. Possible double top bear flag with the high of this bar. A lot of the bulls who see this are concerned that it's a double top bear flag and a strong bear trend, and the bear trend might be resuming, and they'll get out below this bear bar. So they'll get out with a stop below that bear bar. They'll make a little bit of a profit here, but they lost money here. In this case, they would have lost 12 pips on the first buy, and they'll make 8 pips on their second buy, and a total loss of 4 pips on their trade. Anyone looking at this sees that it's very difficult for the bulls to make money. Traders will conclude that the bears are very strong. When you see bulls, scale in bulls, unable to make money, that tells you that the market is probably going lower. And that means bulls will be less willing to buy at new lows because they look to the left and say, hey, the guys who did that before did not make money, and therefore I'm not going to do it now. that increases the chances that you'll get a bear breakout. If the bulls are unwilling to buy at the lows, the market often has to go a lot lower to find buyers. The bears also see how hard it is for the bulls to make money, and that makes the bears confident that the market's going lower, and it makes them more willing to swing trade part of their trade. For the bears, they know the bulls bought the reversal up, but they see it stalling at this high. The market went up and then down and then up again to that same price, a double top bear flag, and now it's reversing down, and they see a gap. Therefore, this might be a measuring gap leading to a measured move down. The bears will sell below that bear bar, betting on a double top bear flag, and any bull is going to get out once he sees that. Some bulls will reverse and go short, but very few traders like to reverse. So most bulls would simply get out. Bears would sell on a stop below that bar, and they would also sell bear closes, betting that we're going lower. They'll sell pullbacks. They'll sell above bars. They'll sell below bars in a pullback, betting that the bear trend is resuming. We have a climactic sell-off, the biggest sell-off late in a bear trend. At the end of the session, a lot of bears will exit on a reversal up, especially above a bull bar. Let's say a bull bought here, he lost money. Let's say he takes a triangle breakout. We have a series of smaller bars, and he tries to take a triangle breakout. He lost money. Let's say he bought at this low. He lost money. Let's say he bought the bear close, betting that the bear breakout would fail. He lost money. He buys on the reversal up. Another small bull bar. He buys on the reversal up. He's losing money constantly. And therefore, it's extremely difficult for bulls to make money. Eventually, any bull who is doing this is going to give up, and you get a bear breakout. The bulls decide that it's not going up, and therefore they stop buying. They want to buy at a much lower price. They think this price is far too high to be buying. If they are buying, let's say buying at prior lows, they have to scale in 2 or 3 times. The risk is big. The channel is so tight, they're almost certainly going to lose money. Again, another gap. This high did not get above that breakout point. I don't even know if it got above this breakout point. And therefore, once the market reverses down, they're going to exit. Again, most traders do not like to reverse. So if a bull bought for any reason, like here and then scaled in at any of these additional places, he's going to get out on the reversal down. And that's one of the reasons why bear flags work so well in strong bear trends. Bulls are going to get out on the reversal down, especially below a bear bar, and the bears will sell, knowing that the bulls will give up and the bulls are losing money. That increases the probability of bears selling here, making money. If you're scaling into longs in the strong bear trend, you cannot make any mistakes because you need every pip profit that you can possibly have. And you have to be absolutely perfect to make money. And even then, you're probably going to lose money when the channel is this tight. You should not be buying in a tight bear channel. Never. Let's say you did buy for any reason and you keep losing money, and then you get a bear breakout like this. Reversing to short is probably the only way you're going to make up for your losses. However, most traders cannot reverse. Even experts do not like to reverse. The only choice is to sell, right? So I would not be buying here. You see the bear breakout. Theoretically, you could reverse and the market comes down here and you'd make enough money to erase these losses, but that's not going to happen. you're not going to take the reversal. And if you did, you're not going to hold all the way to the end of the session. And therefore, you're going to be stuck with a lot of losses. In general, the reason why experts don't like to reverse is if they're thinking buy, 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 it's hard to immediately flip over and think sell, sell, sell. There's too much emotion involved, and it takes a bar or two or three before a bull can get objective again and think properly about managing a short trade. Another bear bar, follow through bar, another follow through bar. So a bear bar and then a bear body, even small, is follow through, and it increases the chances of lower prices. Anytime there's a bear breakout to a new low and decent follow through, bears will use a tighter stop. This is a major breakout, even though it's small. This becomes a major lower high. This is a major lower high, a breakout and follow through. A strong breakout to a new low, breakout bar, follow through bar. This then becomes a major high. Bears will put stops here once they see that. And once they see a strong reversal down, some of the bears will put a stop here. I think it's still probably better here. But here, another breakout in a tight channel. Traders will use a tight stop. Another breakout, series of bear bars. Traders will use a tight stop. And the reason for that is they believe that as long as the market's making major lower highs, the trend is strong and it will continue. If the market starts to go above these major lower highs, then it might be evolving into a trading range and they'll trade it differently. If you're selling in what you believe is a tight bear channel and rallies start to go above major lower highs, then it's no longer a tight bear channel. It might be a broad bear channel or a trading range, but it's no longer a tight bear channel. If you're short on the theory that it's a tight bear channel and the market's telling you that it's no longer a tight bear channel, you want to get out and then reevaluate how to trade. At this moment, let's say you see a bear breakout and a bear close, you decide we're going to get some follow through selling and you sell. You know where a reasonable stop is, here or here, and that tells you what your risk is and it allows you to determine what your position size is. If you're still anxious about entering short at that point, then just trade half that size or a quarter of that size. Trade small, but get short because the market may go a long way and anyone going short for any reason can make a big profit. And if you do not take the short looking for some perfect setup, you're going to miss a big profit. Remember, a tight channel on this time frame is a breakout on the next higher time frame. 5-minute chart. If you were to look at a 60-minute chart, you would see a series of big bear bars closing on their lows. If you see that on any time frame, you know you have to get short. If you're looking at the 5-minute chart, you know a very tight channel like this is a breakout on a higher time frame chart. You have to get short. And a lot of times that means simply selling at the market. How is this different from trading a breakout? Remember, this is a channel. We're getting reversal attempts. In general, if it's in a channel, it's better to be selling above bars or after a pullback, selling on a stop on a reversal down. Traders in general don't like to sell new lows when the market's in a channel. They prefer to sell a little bit above the low, but it's still reasonable. I talked about in a tight bear channel, you only should sell. If it's difficult for the bulls to make money, that tells you that the bears are much stronger than the bulls, and it tells you you should only be selling. Very important. Also, the channels never look like they're going a lot lower, but when the channel is tight, it is going a lot lower, and you have to get short. Rely on an appropriate stop and trade small enough so that you can enter. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading in tight bear channels.